Hey, good morning again, options traders, and welcome back, everyone. So, is a green candle coming due? Of course, we could change this question to is a red candle coming due? But I get this question a lot from traders after we see a streak of, let's say, 7 or 8 or 10 red candles in a row or 10 greens, and they say, oh, a reversal must be coming due. And the reason they say this is they go, well, there's about 50% reds, 50% greens in any given year, or at least over a long period of time. So if we happen to get a lot of, let's say, reds in a row, that now the greens must be coming due. So is this really true? If we have this big streak of reds or greens, should we expect them to turn? Well, let's go find out. And as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and definitely helps to promote the channel. So again, for any period of time, long period of time, we have roughly 50% up and 50% down days. So again, all that means is that over the long term, 50% will be green candles and 50% will be red, roughly speaking. Now, the up percentages will be slightly higher due to the long-term upward bias in the market. But again, the point is that when traders see streaks, they think that the market must turn. And their reason for saying that is, well, the reds have to start coming into play to balance out this proportion, or the greens have to start coming into play to balance out this 50% ratio. And really, this is just a different look at what's called the gambler's fallacy. You hear this a lot among gamblers, and they'll say, well, we've had 10 reds in a row on a roulette wheel, therefore black is coming due. All right, so again, there's a lot of different ways where this fallacy shows up, but let's see why it also applies here to the stock market. First, let's take a look at an Excel spreadsheet. Okay, so now we're into an Excel spreadsheet, and this is the S&P 500 ETF, SPY, and we're going back from 1993 all the way down to April 25th of 2024. So we got quite a bit. That's over 30 years worth of data. And I've just coded Excel to print a 1 if it's an up day. So going from 43.94 to 44.25 is an up day. That gets a +1. If it's a down day, going from 45 to 44.97, we get a -1. And if it's unchanged, such as right here, 44.97 on both days, it gets a 0, unchanged. And so then I just had Excel go through and count. So we know that there were 7,865 changes, and 4,196 were up, or about 53.4%. 3,607 were down, almost 46%, and about 62 of those days, or 0.8%, were unchanged. So again, we can see right here, roughly 50-50, a slight upward bias, but that's exactly what we would expect over the long run. So again, I think most traders, at least intuitively, know this, and that's what leads them to believe that this 50% ratio must stay intact. And so if we happen to get a big streak of greens, we must be ready to see some reds because they have to balance out. But again, that's really what's called the gambler's fallacy. We can even see it with coin flips. So for example, here's another Excel spreadsheet with 30,000 coin flips. We're going to win $1 every time, let's say, that it lands heads, and lose $1 every time that it lands tails. Now, obviously, we'll get lots of varied patterns, but this is just one of many. But the thing that I wanted to show here is over 30,000 flips. Look how long it is possible to stay above 0 or below 0. In fact, look at this long streak right here. Now, these were not all heads in a row, but pretty close. Vast majority of heads. We actually went up $150. But look at how long this streak is where we stayed above 0. And then what happens? We come back to 0. That will always be true over the long run. And then we stayed below 0 for quite a while until we did what? Came right back to 0. So over the long run, we tend to just go sideways. And that is where people think, oh, well, if we've had this long streak of green, therefore we're overdue for red. Or in this case, if we've had this long streak of heads, we're overdue for tails. And it seems that way, but it's really a misperception. So what's happening? Well, here's where the gambler's fallacy comes in. And again, I'm going to use coin flips for the example. The first thing to remember is that the coin has no memory. There's no way that it knows that it just flipped 10 heads in a row or that it's flipped 70% heads. There's no way it could know that. But we do know that the expected percentage is 50% heads and 50% tails in the long run. So if we happen to get a big streak of heads or tails, why do we feel that heads and tails must tend to even up? Well, again, remember, any streaks are in the past. The coin has no memory, remember? What's happening is that the streaks are diluted from future tosses. And that's what's giving it the illusion that the coin somehow has a memory. So for example, let's say that we start off flipping a coin and in the first 10 flips we get 80% heads. Well, does that really mean that the coin knows that and that it must now start producing more tails to even them up? Not at all. This is in the past. The coin doesn't know it's happened. Instead, here's what's happening. Let's say from any given starting point, our expectation is 50%. Okay, yeah, we got 80% here. Of course, it's a very short run, but the coin doesn't know that. So let's say we start flipping again, maybe for 100 flips. And now during this time, we happen to get, let's say, 52% heads. So what's going on here, what's making it appear that tails are becoming more common, is just that we've come back to this 50% and it's diluting this 80%. So in the first 10 flips, we had 80% heads or 8 heads. But in, let's say, the second group of 100, we had 52% heads or 52. So overall, we've had 52 plus 8 or 60 heads out of 110 flips. We're back to 54% heads. But see, the reason that happened is not because the coin knew it and it started producing more tails. Instead, in the long run, we expect 50%, so it starts diluting all of these weird streaks that we may have gotten in the past. Now, we could also look at this, instead of saying it's one set of 100 flips, what if we did 10 sets of 10? Well, it's exactly the same thing. The expectation should be 50% heads. So it just doesn't matter where you start or where you want to start counting these sets. The more you sit there, the more that we start to tend towards 50%. But the thing to understand is that when you see stuff like this big streak of red candles, the market doesn't know that. The market doesn't say, therefore a green candle must be coming due. Now, it is true in the financial markets, there is some psychology. People can see that we've had, let's say, 8 or 10 reds in a row. You might get some speculators that jump in there and want to start buying. And if enough people decide to buy on that day, yes, you might get a green. But the thing to take from this is you don't want to be placing trades just because you say, oh, I know that a green must be coming due. That is not true. The reason we get roughly 50% green and 50% red is because that is a long-term average. Instead, understand that we get this long-term average of 50%, roughly, greens and reds. And so from any given starting point, going forward, we would expect 50%. So no matter what has happened in the past, those will dilute those big streaks. And so that's really the better way to approach the markets, rather than trying to place trades just because you think you know the market must be about to turn. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.